Hello guys, welcome to my channel. In this video we are going to talk about value at risk, and I'll give you more theoretical informations and how they have difference between their different methodologies. Of course we have different value at risk methodologies here, but I want to start with linear and nonlinear derivative to understanding better value at risk. Let's begin, guys. Linear and nonlinear derivative is a really important chapter. Oh, of course, you must know it. You already know it, but I want to explain for you. Linear derivative is mean is briefly you have constant rate. If you have a constant rate and if you have a quant rate, this is a linear derivative, guys. This is really simple. What does that mean? If you have feature or forward contract, this is a linear derivative, but nonlinear derivative is non-constant rate. For example, options. For example, call options, put options. A linear derivative occurs when relationship between an underlying factor and derivative are linear in nature. For instance, an index feature contract is a linear derivative, because our delta is constant, guys. If you delta and delta is constant, this mean is you have linear derivative, guys. Non-linear derivative is a function of the change the value of underlying asset and is depend on the state of underlying asset. For instance, a call option on an equity is an example of nonlinear derivative because option does not increase or decrease at constant rate. If you have call options, you'll have different expectations in the future because there are really big unexpected events in the future. This mean is you have nonlinear derivative, guys. This is really simple to easy to understanding. And then I can give you more explanations about this. For instance, this is a our call options, right? This is a call option price here, and we will have stock price. We have stock price here. This is our tangent line, and this is our payoff, right? This is our tangent line and stock price. For instance, stock price and 20 blah blah blah. I won't give you more information about call options and how they have payoff and how they have curve here, because we need to focus value at risk. Next video, next chapter, I'll give you more information about options and how they have different payoff. And value at risk for a linear derivative in generally value at risk of long position in a linear derivative is uh, var of a long position, guys. Long position formula is delta value at risk f. F mean is feature, guys. Okay, this is the linear derivative and this is our formula, and this is sensitivity, guys. You should know in this math always, you if you have delta, this means we are try to find our sensitivity, right? And then if valuatrix feature is the valuatrix of the underlying factor, and the derivative delta is sensitivity of the derivative price to change in the underlying factor, right? Uh, Delta is sensitivity of derivatives price to change in the underlying factor, guys. If we have delta, if we have delta and we have stock, mean is underlining, sorry. If we have call option or feature, no important, F or feature, and we have spot price and they have sensitivity, This is a delta, guys. Okay, delta. And guys, linear derivative delta is constant, non-linear derivative is not constant, changing over time, right? Changing over time. This is our best difference between linear and non-linear derivative. And we have three different value at risk method. These are historical simulation, delta normal method, delta normal value at risk method, and Monte Carlo simulation method, guys. Okay. If you have historical simulation method, you must be accumulate number of past daily return and rank returns and identify cutoff return, guys. I'll give you I give you some example and I'll explain rank returns and identify the cutoff return. Don't worry. And if you have delta normal method, actually delta normal method have different name. This is a variance and covariance method, guys. Okay. Delta normal, another main is delta normal, another main is covariance and variance method, guys, because this is depend their variance and covariance. All right. And we are using if we are using delta normal method, uses expected value and historical standard deviation while assuming normal standard deviation. Okay, we must be assume normal standard deviation. And if you are using normal standard deviation, you'll have expected return is zero, because mean is zero in normal standard deviation, and this is like a CAPM valuation method, because if you are using CAPM, you must be assume data or stock price and everything must be normal distribution. But if you are using APT, sorry, arbitrage pricing theory, you don't have to assume normal distribution. This is this historical simulation, and that the normal difference looks like arbitrage pricing and CAPM methodologies. And then last one is Monte Carlo simulation method. This is we are using computer generated outcomes to create distribution possible return. We are using simulation method, a method, and we are try to over and over again and changing their return, and we are try to find our worst case of scenario in a simulation, guys. All right. And by the way, if you try to understand Monte Carlo simulation before value at risk, you must be know pseudo number generation, guys. Okay, pseudo number generation. This is using always cryptology and cryptology specialist or area, because this is a crypto chapter, guys. And Monte Carlo simulation coming from pseudo number generation. You need to understand better pseudo number generation than try to understand Monte Carlo simulation. And in the next video or next chapters, I'll give you some explanation and difference between pseudo number generation and Monte Carlo simulation and bootstrapping. They have really big difference. How can you use to understand better why we need to use when we need to use it? And I want to give you historical value at risk example here and explain rank return and identify cutoff return, guys. All right. Assume we have accumulated uh, 100 daily return here, and our investment is 1 million, guys. All right, million, guys. This is main portfolio. After ranking returns, we need to find highest and lowest and identify your 5 lowest return here, guys. All right. I'll give you 5 different lowest return here. For instance, minus 0.0 point and minus 0.002 minus, sorry guys, minus my bad, minus 0.004 and minus 0.008 and minus 0.015, guys. All right, we have different five return here. We must need to determine which one is highest or lowest, guys. Okay, now we are calculating our value at risk at 5% significance using historical method, guys. All right, we are using 5% significance and try to find our value at risk method here. These are lowest five returns, so they represent 5% lower tail of the distribution of 100 historical return, guys. We have 100 historical return and 1 million portfolio. We have different five return, and we need to determine which one is the lowest and highest. And we will say there is five chains of daily loss exiting is 1% or 1,000, because 1 million times and 1% equal 1,000, guys. This is really easy to understanding. This is our value at risk daily loss exiting, guys. All right, and our lowest and highest return is here 1, 2, and uh 1, 2, 3. Sorry, guys, I'm really too bad to writing because my pen is changed and I couldn't try to use it. And 4 and then 5, guys. Okay, 4 and 5, guys. Okay, we have value at risk here 1,000. And if we using historical simulation, we are not having to assume any particle distribution. What does that mean? That mean is this is a non-parametric, guys. We always have different two methodologies in value at risk. This is not subtitle, this is title. uh Parametric and non-parametric, guys. Okay, not having to assume any particle distribution mean is non-parametric. And assumes past performance here. We are looking past performance here, and assumes past performance is representative of what can occur in the future, right? This is our disadvantage, guys. Assumes past performance and representative of what can occur in the future, only depend the future. But in the real life, sometimes past is not representative for the future. We always must know this, guys. Okay, we always must know this. This is really important. And then we have delta normal value at risk, guys. All right, delta normal value at risk. And then delta normal value at risk have little long formula here. This is expected return minus z score times sigma and times value our portfolio. Okay, this is our value of portfolio. This is our sigma. Sigma means standard deviation, and z score. And this is our expected return, guys. Okay, expected return. And this is our z value mean is z score. Sorry, guys, I'm really bad. Z score, and then this is our standard deviation. But not that this is really important. I already told you one time. Uh, expected return often often zero. Okay, expected return is often assumed to be zero because we are using z score here, and standard deviation always it is based on normal distribution. What does that mean? uh Mean is zero, guys. You know, variance 1, mean is 0, secant is 3, curve is 4. And delta normal var example, I need to show you. uh we are supposing the historical standard deviation stock index is 5% per day. Okay, 5% per day, per day. Stock index, all right? Stock index. This is a stock index example because if you want to invest, if you want to invest 10,000 index, and we need to calculate our value at risk and interpret maybe. And if you are using 5%, 5% stock index per day historical standard deviation, and you are invested 1000 investment, and one day 5% value at risk, guys. This is a significance level, guys. Okay, this is a significance level. What does that mean? We have 1.65 confidence level. By the way, uh, let's give you more information here. If you have 1% significance level, you'll have 233 confidence level. If you are using 5%, sorry guys, 5%, you'll have 1.65. These are using for two-tailed, okay, two-tailed, guys. Now one-tailed, no left or one segment or one tailed. Okay, guys, always remember this. We are using 5, we are using here 5% value at risk. So we need the formula here, 5, 1.5 confidence interval times uh times 5% and times our investment, guys, right? Investment, this is our portfolio, this is our standard deviation. So our value at risk is 82.50, guys. This is really easy peasy, guys. Don't worry, easy peasy. This is our value at risk with delta normal value at risk. Just always remember, mean is 0 and depend normal distribution, guys. All right, normal distribution. Always remember only here. And by the way, this number 82.50 is one day. Okay, one day 5% value at risk is 82.5, guys. All right, 82.5. And the delta normal is a ease of application like a plank and chalk. Plank and chalk mean is easy, and this is our advantage, guys. All right, this is our advantage. But reliance upon simplistic assumption, such as normality, you know, market distribution tend to have fatter tails normal than normal distribution. If you have fatter tail, that's mean you have leptokurtosis here. This is about leptokurtosis, and the fetal tail mane is, you know, leptokurtic, and you should analyze and determine your distribution to here. This is really, application is easy, but data regulation and data manipulation is important here. Option portfolios are not normal distributed. What does that mean? If you have option portfolio and they are never almost never normally distributed, not normally distributed, so mean delta normal is not available, not suitable, guys. Okay, always remember this. These are really important. These are really important to mathematical formulas. And we need to understand here Monte Carlo approach, guys. Monte Carlo approach. Monte Carlo approach is simulate thousands of valuation outcomes for underlying assets based on the assumption normality, right? Based on the assumption normality. Uh, for the value at risk for the portfolio for derivatives in then calculating from simulated outcomes. We are determining easily in simulation method portfolio derivatives and what you have, and general equations assumes the underlying asset has normally distributed returns and with a mean of mu, mean of mu. This looks like an, but no, this is a mu, guys. Okay, mu and a standard deviation, and standard deviation is sigma, guys. All right, sigma. Of course, we have different advantage and disadvantage here. This is our most powerful method, is our best advantage in Monte Carlo simulation, and risk department and another finance department generally using Monte Carlo simulation to determine their value at risk and worst case of scenario, and it can account for both linear and non-linear risk is our another advantage. It can account for both linear and non-linear risk, our best another advantage here. But disadvantage in Monte Carlo simulation that is many assumption required. Many assumption required. We should change our yield curve. We should change our non-constant rate. We should change our everything with based on different scenarios. Okay, and then another disadvantage is computer time, guys. Computer time. Great deal of computer time and calculations, but of these days this is really easy. We have really powerful computer and calculation tools. This is are not important today, but uh, if you have different high and big explanations or calculations, maybe your uh, computer or uh, tools not sufficient for you. And then we have conversions for value at risk, guys. We are conversion for value at risk. What is conversion value at risk is a value at risk typically measure of risk of loss in asset value. We have asset and we are trying to determine our uh, value at risk. I mean, worst case of scenario, our worst uh, asset money in the future. And the typical measure risk of loss in asset value over 1 day period. Risk manager may however be interested in measuring risk over longer time periods, guys. Sorry, over longer time periods, such as a week, such as a month, quarter, daily, yearly. How can they wanna choose? And value at risk can be converted from a 1 day. Value at risk can be converted from a 1 day a 1 day basis to a longer basis using the conversion formula. We have different conversion formula here to understand our conversion value at risk. This is a easy and value at risk as per x percent j days equal value at risk x percent 1 day and root j, guys. All right, root j. This is our conversion value at risk. And if I want to give you an example about this, if value at risk on daily basis equal 3000, and what is our value at risk on a weekly weekly basis basis value at risk on an annual, okay, annual basis, guys. Please understand here better. If you have a question here, please comment me and assume 5 days for a week. 5 days for a week. For a week. And 250 days per year, right? 2 days per year. We need to find our conversion formula. We need to find conversions for value at risk, guys. Okay. Value at risk 5 days weekly 3000 times, this is our j, right? J here. Uh 5000, sorry, 3000 root 5 is equal, sorry guys, equal uh sorry, equal 5000, sorry, equal 6,600 78, okay, 7800, yes, this is right, this is true, 78. Another one is value at risk 250 day is mean annual equal 3000 times 250 is equal, wait me, 3000 times root 250 equal 47,000 for uh, for 34 434, guys. Okay, this is our conversion of value at risk here. All right, but always remember here, I never forget it. I never forget it. I need to say you these equations, assumptions mean they do assumption assumption mean mean is zero, guys. All right, mean is zero. Okay, mean is zero. Always remember this, guys. Mean is zero. Um, mean is zero. Yes, guys. If you don't understand, please watch again it, stop it, and watch over and over again it. And if you have a question, please comment me or send me private message. I'll help you. And correlation breakdown, guys. This is another important chapter in value at risk uh, correlation breakdown. Okay. The key point here is that times of crisis, we have different crises in the past. For instance, subprime crisis, guys. It was really big. Correlation increase mean is some substantially, immediately, substantially, and strategies that rely on low correlations fall apart in those times, guys. Okay, in those times. Certain economic or crisis event can cause diversification benefits to deteriorate in times when benefits are most needed. Yes, yes. Deteriorate times when benefits are most needed. And we have contagion effect here. Contagion effect occurs with a rise in volatility. Okay, contagion effect, guys. Look, contagion effect. I am looks like a doctor. A contagion effect occurs with rise in volatility and correlation causing different return generating process, guys. Okay, remember always it. Remember. Another chapter, if we have stress testing, you already know it. I know stress testing is really popular example in finance. We are using different stress, different scenarios, and we are trying to understand our value at risk or our loss in the future, and examine historical crisis events such as October uh, 1987, 1987 market crash crisis. Another example, subprime, no matter. Uh, October 1987 market crash and assess the impact on the current portfolio, right? They really affected their portfolio. And the historical simulation approach does not limit to analysis to specific events, right? They are based on only past data, but we never expect any limit analysis to specific events for historical simulation approach, guys. An alternative approach is to analyze different predetermined stress scenarios, such as a shift, shift yield, shift up or shift down, or LIBOR or SOFR or another what you have. I don't know your rate, constant rate, non-constant rate, changing our non-constant rate. We are trying to understand our portfolio. And if you shift in yield curve and then evaluate the effect of the stress scenario on current portfolio, guys. This is a stress testing, guys. If you change your portfolio and sorry scenarios, you'll have different consequences, and you need to understand your portfolio uh, expectations in the future, guys. All right, in the future. And uh, last chapter is worst case of scenario. We have worst case of scenario. And what is worst case of scenario and worst case of scenario measure, guys? This is easy to understand. Assume that unfavorable events will occur with certainty, guys. Unfavorable event will occur with certainty. This is our worst case of scenario, guys. The focus of on the uh, distribution of the worst possible outcomes, guys. Possible outcomes given unfavorable event, guys. All right, even for unfavorable event. And this is our normal distribution, guys. All right, we are looking to try sorry, we are looking to determine our tail event. Okay, this is 5%, sorry, 2.5, 2.5. We try to understand events here, guys. Okay, only we try to understand here. We need to find our worst case of scenario at the tails, because these are unfavorable events, and here is always it occurs over and over again, past and future. This is our normal days, guys, but here is not normal. This is unfavorable, guys. Okay, unexpected loss is determined from this worst case distribution analysis. Okay, guys, the worst case of scenario information extends the value at risk analysis by estimating the extent of the uh, loss given an unavailable event occurs. Another example to understand think better value at risk, guys. We are using value at risk in risk management with different chapters. If you are a risk management specialist, you know we have expected loss, guys, right? Expected loss. Expected loss is equal PD times LGD times EAD, right? This is our equation to find expected loss ratio. Okay, this is our expected loss ratio. But if you try to find unexpected loss, what should you do? We are trying to we are trying to determine our unexpected loss. This is easy, guys. If you are expected loss minus value at risk, guys, this is our unexpected loss. This is easy, guys. Only you must understand methodologies and choose right methodology and carefully their feature and how they affect your analysis. For instance, if you are using delta normal distribution, sorry, delta normal value at risk, you must know mean is zero, guys. Okay, historical is really easy. You don't have to focus again and over again. Just choose your highest and lowest return. That's enough. If you are using Monte Carlo, you have to focus your simulation, because if you are using 1,000 and 10,000 simulations, you'll have different consequences or output, guys. I'll give you next video, or maybe next time in the future, uh, what are different pseudo number generation and Monte Carlo simulation and bootstrapping, guys. Okay, bootstrapping, guys. They looks like the same, but they have really big difference implementations methodologies, guys. Okay, thanks for watching me. Next time I'll give you an Python example, and I'll give you exercise in Python. Sorry, repeating. uh, we will have portfolio and portfolio management with value at risk, with using Monte Carlo simulation. You'll see covariance and sigma standard deviation and Monte Carlo process. Okay, guys, thanks for watching me. See